Major continuation patterns. In this video, you will learn the various types of continuation patterns, such as triangles, wedges, pennants, flags, and rectangles. A prerequisite for any continuation pattern is the existence of a prior trend. Continuation patterns indicate a temporary pause in the trend, where prices consolidate before resuming in the same direction. The next move will be in the same direction as the trend that preceded the formation. Trading volume plays an important role in confirming these price patterns. The most common trend continuation patterns are triangles, wedges, flags and pennants, and rectangles. There are three main types of triangles: ascending, descending, and the symmetrical triangle, which can be both bearish and bullish. In the case of bullish triangles, the pattern contains at least two lower highs and two higher lows. When these points are connected to an apex, the triangle is formed. Volume should decrease as the price moves within the triangle. The breakout is expected to happen between 2/3 to 3/4 of the width of the triangle. Volume should increase as the market breaks out of the pattern. The opposite formation found in a downtrend is the bearish triangle. For the measuring technique in the case of a bullish triangle, the first technique is to measure the height of the base of the triangle and extend that distance from the breakout point. The second technique is to draw a parallel line to the lower triangle line. Where the parallel lines meet the apex, we know where the price will be and when the price is expected to reach the level at the date where the apex is. The same is applicable for the targets of a bearish triangle. For a bullish wedge, the pattern is identified by two converging trend lines that are wide at the base and contract as they come together at an apex. It is an intermediate pattern that takes more than 25 candles to form, but not more than 75 candles. The bullish wedge has a noticeable slant to the downside against the prevailing uptrend. A falling wedge is considered bullish. Like triangles, the same breakout periods and measuring techniques apply. The opposite pattern is that of a bearish wedge that has a noticeable slant to the upside against the prevailing downtrend. A rising wedge is considered bearish. Two other continuation patterns are the flags and the pennants. The flag and pennant represent brief pauses in a dynamic market move. They are both preceded by an almost straight line move, called a flagpole, which happen on heavy volume. Prices then pause for a few candles on very light volume. The move continues on a burst of volume. Both patterns occur at about the midpoint of the market move, which means the market is expected to move up at least the distance of the flagpole. The opposite is the bearish flag and pennant, where prices form a flag or a pennant after a decline before resuming a downward move. After breaking out of the pattern, the market is expected to continue downwards until at least the distance of the flagpole. For a bullish rectangle, the pattern is easily identified by at least two similar highs and lows. If rallies are on heavy volume and setbacks on lighter volume, then the formation is probably a continuation in the uptrend. However, if the heavier volume is on the downside, then it can be considered a possible trend reversal. The opposite case is that of a bearish rectangle. Again, if setbacks are on heavy volume, then it is probably a continuation in the downtrend. However, if the heavier volume is on the upside, then it can be considered a possible trend reversal. In our next video, we will talk about moving averages and MACD. Thank you for watching.